Hi, I'm Todd Rosenbluth, head of ETF and mutual fund research at CFRA. And thanks for joining us. We're going to talk about choosing a fund based on not just past performance and how it added value for CFRA. We at CFRA are an independent research company, and we provide a unique approach to analyzing ETFs and mutual funds. We take a more forward-looking approach, looking at what's inside the portfolio and leveraging our team of in-house fundamental and forensic accounting analysts. We like to look for funds that are more likely to have consistent returns from a baseball perspective, looking for singles and doubles, as opposed to a fund that's swinging for the fences and often striking out. And this forward-looking approach differentiates us from what others in the industry are doing. Now, it's very easy to take an easy approach to choosing funds. In the United States in particular, people tend to look at the expense ratio or historical performance or even the issuer of the fund, whereas in other geographies, they take a slightly different approach. But we at CFRA think that's not the right way of looking at it. You have to dig deeper and know more than just one or two data points. Here's why. If you look at an ETF or a mutual fund based solely on the expense ratio, you notice major differences. This happens to be a couple of ETF examples where the Vanguard Growth ETF has significantly outperformed the iShares Morningstar Growth ETF, despite charging the exact same fee. And another example is that if you relied solely based on past performance with an actively managed index or actively managed ETF, such as ARC, you can see in the last 3 years how well that ETF has performed, but in the more recent period of time, it has significantly underperformed. In the inverse, we have a cannabis ETF under the ticker MJ that significantly underperformed in the last 3 years and has been outperforming in 2021. Looking in the rearview mirror when choosing a fund comes with significant risks, and that's why we at CFRA go beyond that. Now, you could also look at the issuer or the asset manager. You could choose just based on what product they have and what is cheapest. But again, you would find notable differences in what's inside the portfolio and what the overall performance is, whether it's an index-based approach or an actively managed approach. The last thing is we find that some people are comparing ETFs and mutual funds using the same database. They're basically shopping for apples and oranges together, but they're quite different. We at CFRA notice that most ETFs and most ETF assets are index-based, whereas most mutual funds and most mutual fund assets are trying to outperform an index with security selection. In addition, investors in the ETF are quite likely to buy a product or consider a product that is less than 3 years old, whereas that 3-year benchmark or 3-year anniversary is extremely important when choosing a mutual fund. So you don't want to compare ETFs and mutual funds with the same database if you don't have the same considerations. In addition, the costs matter differently. From an ETF perspective, there's trading costs, there's the price to net asset value, whereas with mutual funds, the expense ratio is a significant driver, and there's often a wide gap between funds that you might be considering. And then lastly, and perhaps most importantly, most mutual funds fail to deliver consistent performance. Winners in one period of time often fall back to the pack, and funds that have lagged often revert back to the middle. That's known as a reversion to the mean. As mentioned, we at CFRA like to see consistency. We want funds that are consistently in the middle or slightly above average with their performance. It increases the likelihood that they're going to outperform in the future. And that's the way that we at CFRA built our research methodology. We have ratings on over 15,000 mutual funds and separately almost 1,900 ETFs. We use a machine learning approach where we're trying to identify what funds have the greatest likelihood of outperforming based on a number of characteristics, specifically reward, risk, and cost. We're looking at the holdings inside the portfolio, identifying what is likely to go up or down in value. We're looking at the tenure of management. And as mentioned, we're looking at the expense ratio. And we're using our own in-house data to power this research and drive the overall ratings. Here's what the research looks like. On the left, you have an example of an ETF report. In the middle, a mutual fund report. And on the right is more thematic research where we try to highlight a key trend and look at the mutual funds or ETFs that are likely to benefit from that trend. And we've written a number of those pieces up on MarketScope Advisor, and you can learn more about that and we'll have a link at the end of the presentation. You can see here we have cost, reward, and risk, where a high risk score means it's relatively cheap, a high risk score means it's relatively safe, and a high reward score means it has significant upside potential. Those are true in all three cases for this example. We also break down our universe of mutual funds into 5 categories, 2 equity categories and 3 fixed income categories, credit focused, government focused, and a municipal bond category, because the drivers of mutual funds are different between these categories. So how have we done? We're really excited at CFRA 1 year into our updated mutual fund rating methodology to show you that 5-star rated mutual funds in the US equity category significantly outperformed 3-star and 1-star funds. In fact, you'll see a stepladder approach here, where 5s beat 4s, 4s beat 3s, and then 2s and 1s lag behind in both cases. And there's been about a 3,000 basis point difference in just the first year between our 5-star funds and the 3s and 1-stars. We're really excited about how this performance has happened. And we think as we look currently at our mutual fund universe, you'll notice some differences between how we rate a fund and some of the competition. So we have a 5-star on Invesco's Main Street Fund. The ticker is MSIGX. We think the fund has relatively low risk considerations and a below average cost structure relative to its broader US equity category. Whereas Morningstar has a 3-star rating that is based on the performance record versus its large cap blend universe. They're looking solely backward, whereas we're using a combination of the track record, the costs, and the holdings to help us drive a rating. We see a similar differential between the Fidelity Small Cap Discovery Fund, which Morningstar has a 3-star rating on relative to its small cap blend peers, where again, we at CFRA like the cost, we like the risk profile, but in addition, we think this fund has high reward potential. And lastly, let me show you how our 5-star credit-focused mutual funds added value in our first year. The top picks outperformed the bottom picks by 1,000 basis points. Now, these funds tend to have more of a income as well as some capital preservation approach. So it's really interesting to us that there was big disparity between our 5s, 4s, 3s, 2s, and 1s. Again, a stepladder approach took place, which is significant given that the value was being added, in our opinion, by mitigating the risk as well as generating strong reward potential. Here, we show 2 different examples. One, a high yield fund, the AB High Income Fund, AGDAX, which we at CFRA think has strong reward potential and moderately low risks, whereas Morningstar has a 2-star rating on this high yield bond fund. Federated Hermes Corporate Bond Fund has a combination of investment grade and high yield bonds, and we at CFRA like it for its relatively low risk considerations and its average cost. Morningstar has a 3-star rating on based on its performance record versus a corporate bond universe. Again, we have a different approach, and it's why you can look to us as a differentiator when sorting through the mutual fund universe. Overall, we had success in our first year. 5-star rated funds in all 5 of the categories, including global equity, credit focused, government focused, and municipal bond funds, all the 5 stars outperformed since we revamped our methodology. How is that possible? Well, we take a forward-looking approach on nearly 17,000 mutual funds, assessing the holdings, assessing the portfolio's performance record, and its cost structure to make sure that we're giving a holistic view as to what has happened with the fund and what's ahead. Lastly, we're an independent research company. Some other folks are covering funds that they themselves have a connection with. We at CFRA do not have an asset management arm. We do not rate funds we're connected to, and we're not competing with our end clients, which is why our clients continue to be happy using our fund research. To learn more about CFRA's fund research, both ETFs and mutual funds, you can visit this link that's on this page to learn more about how we are differentiating our analysis versus the overall universe. Thanks for joining us, and have a great day.